You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Well, jumping right into today's program, there's a wide range of issues impacting market structure, regulation, risk, and operational resiliency. Moderating our first panel of the day, help me welcome Alicia Crighton, Managing Director, Goldman Sachs, and their panelists, Scot Warren from OCC, Slade Winchester from Citigroup Global Markets, and Steve Luparello, formerly of the U.S. Securities and Exchange Commission.
Well, good morning, everyone. Thanks very much for joining us today. It's really nice to be here in person. I think the last time we did a version of this, we were on Zoom, so this is way better. Why don't we go ahead and get started? Maybe I'll ask my panelists to do a little bit of an introduction on themselves, and then we'll dig in.
Okay, I'm Scot Warren, and I'm OCC's Chief Operating Officer.
Slade Winchester with Citigroup Global Markets, and I oversee global derivatives platforms.
And Steve Luparello, I'm the recent past director of the SEC's Division of Trading and Markets and former general counsel at Citadel Securities.
Great, thank you. And I guess before we get started, just one note. I think both, and most of you know this, Scot and Steve have announced their retirements. So on behalf of the industry, thank you for your service. Thank you for all you've done on our behalf. And we're definitely looking forward to today's unfiltered discussion.
Well, we do want to stress that we are protected by the Endangered Species Act.
I think Scott's usually unfiltered, so extra unfiltered is a little worrying, but we'll see how it goes.
Great. Well, we know we have a couple of interesting topics that are, continuing to sort of percolate throughout the industry, whether we're thinking kind of crypto, PFOF, presence of retail. There's probably some intersection across all of those that we'll want to dig into a little bit. But why don't we start with retail? I think in many of our conversations over the last day or so, there's been a lot of focus on what is the impact of retail in our markets, whether increasing volume, decreasing volume. Why don't we start with that? Scot, if you want to start.
Well, I think the hard part is if we all spent the next week, I'm not sure we'd agree on definition of retail, sure. Right? So OCC's perspective is we need to risk manage for the industry. Having a healthy and diverse set of market participants is critically important with well-capitalized firms behind them. So we've seen a lot of trends. You see decreasing average lot size. You've seen increased order flow. You've seen the ratio between open interest and trades actually decline. So it looks as if we've got more participation in the market, which is generally a good thing. And so as long as we've got the right products and services, I think how we classify market participants is probably less relevant than are we serving the needs of market participants and are they getting access to the products and services they need?
Mm-hmm. That's a fair point.
I think retail has taught us all a lot about what structure they're really going to embrace. And I think some of the panelists yesterday kind of touched on that, where the simplification of our very complicated market structure and products into, I want to buy a call, or trying to understand what a call means or performs, or a put, or writing a call, and the simplification of that. And I'm trying to take that trend internally, like at our bank, for our institutional traders who deal with much more complicated interactions with the market, and how do you simplify that so that they can more efficiently hedge their exotics risk and more complicated products. And I think retail's really taught us that they will come if you simplify the interaction with them. I mean, we all love Amazon. You know, I need a garlic press. Boom, I have a garlic press in my hand probably in 3 hours. It's crazy. And if I want to get upside exposure in Tesla, okay, this incredible app is going to tell me. And if you want a more complicated interaction with the market, you know, Schwab, Ameritrade, Thinkorswim will provide you something more complicated. But it's really teaching us that we need to simplify the interaction between the users and the marketplace, to me.
Right, and I think that's a sort of great way for the firms to think about it. But I think the regulators then need to think about how does the change in the makeup of participation drive any changes that are needed in the protections that have existed, right? So retail has been involved in the options markets forever, and there are a suite of sales practice and other types of protections that are built into the regulatory scheme. Does this sort of increase in the number of participants and the changes in the way they participate compel changes to the regulatory response? And I think that's something that folks are thinking about but need to think through probably a little bit more.
Stephen, I think that's an excellent point, and I'd like to thank one of my colleagues that's here, Karen Bielik. Option disclosure document is something that had grown and evolved over time, and it's a critically important regulatory component to make sure that people understand the risks of options. I think the rewrite of that document has gone a long way to making it simpler to understand the risk characteristics of options. And then my colleagues at the Options Industry Council have also provided some online interactive tools to make it easier to understand. And I think that's really incumbent on all of us, is to make sure that the market participants understand the risks of the products that we're offering.
And that's a great point, right? If the industry itself can move forward in that direction, right? And obviously the ODD has an SEC component to it as well. But if there's a sense that people are getting in and understanding what they're getting into and how they're getting into it, I think that can influence whether the regulators feel the need to step in as well.
And how do you think the regulators judge that, right? How do they make that decision of, do people really get it? And then what burdens does that put on us as kind of industry participants to ensure that right balance?
That's a very good question, right? It's in some ways no different from how the regulators, especially the SEC, I think traditionally have thought about whether there's a need to step in, right? A lot of that comes from where the noise is coming from, and a lot of it comes from what inputs they get from a variety of different constituencies. And those constituencies aren't just the industry and retail investors, obviously. It's the press, it's the Hill, it comes from a variety of different directions. Mm-hmm. And so I think that it speaks to a bunch of things, but one of the things it speaks to, I think, is interaction as early as possible on issues like this, because other constituents are in there making points, and you want to be able to ensure that the regulators are getting calibrated, balanced views of what the current state of the market is and what the potential solutions or non-solutions exist in terms of how they should move forward. And I think we've seen that in the retail space already. Obviously, retail customer protection seems to be a big component of what the SEC is thinking about from a regulatory and market structure standpoint. Mm-hmm. And so that sort of perpetual interaction, I think, is really important.
Yeah, I think I'd love to hear from a regulator how they think about the growth that we've had over that chart yesterday that was up above the retail panel, that true hockey stick growth. And people aren't doing that because they're having a bad experience. Like they're doing it hopefully for the right reasons. I would assume at some level they're not blowing themselves up and have massive complaints. Like, you would do it once or twice and be like, I'm done. If you're having a bad experience, if you're having a good experience, and I assume they're making money by the strategies they're using, and it's really all about the education, but how the regulators would think about, like, what's bad. And I totally agree. An uneducated option trader, to me, is like terrifying. And making sure there is some level of competence to it. But people are coming back and using the product over and over and over again, seemingly.
Mm-hmm. Right, and it goes back to, right, so there is this suite of protections that have evolved over a period of time that were generally considered to be well tailored when the level of retail activity was here.
Yeah.
When the level of retail activity is here, is it of a different type, or is it different types of people that make you reconsider whether that existing suite of regulatory protections is no longer adequate?
Yeah, I would say on a personal level, like the ODD, I've never read it. I would think most people like you get it electronically now, and it's like accepting your Apple iPhone update, where you're like, yeah, I read this whole thing.
But now it's credible you could.
Yeah.
Right. It is consumable. It's on point, and then they're supporting interactive materials that help that education process. And I think about the firms and the amount of time and effort they spend on the education initiatives, our colleagues at the Options Industry Council, how focused they are on it, because I agree 100% with Slade. People that are uninformed and uneducated in how to use the tool end up hurting themselves, and I don't think that's what any of us have an interest in.
Yeah. Agreed. And I think we talked about this, as we were preparing for this. There's obviously a proposal in front of the CFTC at the moment on a disintermediated model. And I think that goes directly to this, right? If we think of what are all of our different roles in the ecosystem, how are we thinking about market integrity, providing education, providing risk management, doing credit checking, ensuring some sort of framework that kind of keeps the sort of system running. That proposal sort of changes a lot of that, and it puts a lot of those responsibilities in the hands of the clearing organization itself. What do you think about that and the impact that could have if that proceeds on the kind of current track that it seems to be proceeding on? I think there's a lot of interesting changes that it suggests. There's a lot of things to digest in there, but I think the regulatory engagement around that will be pretty interesting.
It's easy to be on the wrong side of history and try to be a preservationist.
Yeah.
But you look in the things you mentioned, I think are what's critically important. You want to be transparent and open, so a market participant understands what they should get and what the risks and rewards are. And a lot of the structure has in place a lot of protections at different levels. And so to the extent you start changing where and how those work, we need to make sure that they're really well understood. In my world, default management, customer portability. So if the exchange, who's now also clearing the customers, fails, what happens to those customer protections? Did the retail customers really want to mutualize the risk to each other? So it's just making sure if they do, that's fine, but they've got to understand they're making a conscious choice. And so a lot of this is making sure that the customer protections are there, whether it's customer portability, default fund management, best execution obligation. It's hard if you're both the exchange and the clearinghouse of who ensures best execution. So it's just making sure that there's a thoughtful process to make sure that all those protections that we all think are very important for market participants persist.
Yeah, and at Citi, there's quite a bit of focus on them. Our prime brokerage entity has their risk controls, but a lot of new discussions about agency-only credit risk, and how well do you know the finances of your customer, and are they able to post the capital in times of stress for the executions you're doing at the clearing broker where they are. And it's been an interesting journey figuring out the path of that credit risk and how you manage that. And that's something we've been focused on. I believe a lot of other agency broker-dealers have similar asks to make sure you're watching that credit risk.
Yeah.
And I should say that even when I was at the SEC, I would always, in situations like this, have to remind people that I didn't speak for the SEC, and now it's 10 times more true that I wouldn't speak for the SEC. And so I can't claim to any special insights into how they think about issues. But I do know historically that sort of the notion of the broker-dealer layer as an important gatekeeper and an enforcer and an element of investor protection has been something that's really deeply, deeply ingrained. And I can't imagine any sort of shift in terms of the philosophy around that. So I think, in fact, it's probably more likely that more and more is placed on all the levels in the industry as not just access to the market, but as gatekeepers for investor protection.
Well, and Slade also pointed out, broker-dealers extend a lot of credit to their clients, right? And so now is the exchange going to be doing that? There's a lot of risk management functions there that are critically important that we make sure how that protection and potential conflicts of interest are disclosed.
Mm-hmm. Yeah, no, agreed. Do you think this type of model lends itself more to just crypto, or is there applicability in more markets? And I think you were starting to say, before, clients go directly to options exchanges, or even, in this construct, directly to the OCC.
I don't think the asset class matters. I think it's the model and the structure. And I think, people extrapolate market structure, and we've got in both futures and options well-established market structures that hopefully instill a lot of confidence in market participants. And so you can have a new market come up and market participants assume those same protections arise, when clearly I don't think that's the case. And so I'm not smart enough to tell you what the value of Ether or Bitcoin is, but I do know that I'm not sure that everybody understands the market structure. So is the product that I traded on that exchange fungible? Where's my wallet? What happens if that intermediary or exchange is no longer viable? What's my recourse? Is there portability? What happens when bad things happen? And that's what's critically important to have confidence, is that things happen. And then my favorite thing is the TV ad where I can deposit cash in an ATM and get Bitcoin, and I'm still confused of what best execution quality is in that case. And lo and behold, I bought at the high of the day every time.
Yeah, no, makes sense. Well, if there's nothing else, maybe we'll kind of leave crypto and intermediation or disintermediation there. Maybe we'll transition to CAT. Again, I think there's been some discussion, I know in some of the bilateral conversations I've had over the last few days, and I know many of us have, lots of time, focus, energy, dollars, resourcing put at CAT. I think we were talking about, as we were leading into this, the exemptive relief ends on July 23rd. Kind of where do we go from there? What are some of the implications of that? And would appreciate your perspective.
So I also, for the last couple of years, oversaw the Citigroup Global Markets implementation of CAT from the business perspective, which was really fun and cool. And I had 606 thrown at me too, because I'm so fun. But there is. So I'll explain a little bit what Alicia was alluding to. The final phase of CAT, Phase 2E, ends July of this year. But there was 5 parts of CAT that had a exemptive relief for, and 2 of them, I think, or one of them, and a lot of people in this room should have a lot of interest in. They expire in July 31st of 2023. One is for, I wrote down the actual wording in the, I have to find it here. It's the firm quotes by market makers on a trading floor would be CAT reportable if this exemptive relief is not extended or made permanent. And upstairs, firm bid-in offers for phone calls and unstructured communication, i.e. IMs, would be reportable even if they don't turn into orders. So a market maker on the floor, I'm 11 at 11 and a half, 100 up, would be a response to a floor broker would be reportable. And then an institution calling a sales trader saying, where are you on, I'll keep it simple, to buy 1 million shares of Microsoft. I'm on the offer. No, I'm seeing better way. Click. That offer, because it's firm, you're not going to back away from it, would be reportable in CAT. And I don't really have a dog in the fight whether it's appropriate or not. I'm just more worried that the industry isn't fully aware that these are out there, that people either weren't that versed in the rule, or they've kind of forgotten about it. It's like, oh, I'm done with CAT. We're all done. Well, there's a couple big hanging chads or tails to this. Cat tails, yeah. I said it. And how, when we get clarity around that, because that's really going to change workflows. And that's more what I'm concerned about. If at what point do I have to go really engage with the sales trading department to say, you guys have to change your workflows and the way you communicate with clients so we can at least somehow turn your conversation into a structured JSON message that we're going to submit to CAT. So it's something that I have concerns about, whether the regulators want it or not, or should have that information. I'm not going to go there. I'm just more about how a broker-dealer is going to implement that rule or an exchange.
Yeah, and I think I think an expectation that because it's difficult, it'll get pushed out again is certainly could happen, but I don't think one could count on it. And I think part of the reason is the cat journey is a very, very long one. And if you go back to when it was first contemplated and first proposed, it was clearly there as a market reconstruction and analytical tool. Over the last 10, 12, 14 years, whatever it's been, it has clearly morphed into primarily an enforcement tool. And I think so long as that's the type of information that the Commission and the SROs would think would be helpful as enforcement information, there's probably going to be a desire to capture it. And I would suspect that while it's certainly possible that things could get extended and it's certainly possible that things could revert, I think people are going to look at that type of information as useful information in enforcement investigations and want to grab it when it's available.
Yeah, that makes sense. We'll transition again. Maybe we'll touch on PFOF, again, another topic of significant debate, both here at the conference and within the industry at large. I think general consensus, unclear. Clearly, the SEC is focused on it. Unclear what the action is. Do they move swiftly or not at all? I know one of the things that we wanted to make sure we touched on, and I'll hand it over to you in a minute, is sort of talking through differences between the model from an equities and an options perspective, and then thinking through what are the alternatives, if any. So, do you want to start? Yeah. Sure.
Again, not speaking for any of my former employers, immediate or deeply in the past, right? I think again, it's when a regulator thinks about the issues, right? They have to think about what is the market failure that needs to be solved, and then how can you solve it in a tailored way? And I think PFOF creates some sort of obstacles to the simplicity of that thought process, right? Part of it is that PFOF in the option space, as you say, is fundamentally different from PFOF in the equity space, and that's in part driven by the market structure, but also that there are equivalencies in the markets for both those things. So there's PFOF and there's rebates, and if you tried to ban certain things, they just morph into areas that are even more opaque. And so assessing that it seems to be something that just seems a little icky and causes the potential for conflict of interest, that part is easy. Coming up with something that's actually helpful, I think, is a little bit more difficult, which is why I think historically this conversation has popped up numerous times over a long, long period of time. And enhancements to disclosure is always the place where people seem to end up, right? So long as you know what you're getting and so long as it's well understood, that's a place where the regulator seems to be able to do something good without causing any unintended consequences. I don't know, having worked on something that enhanced PFOF disclosure less than 5 years ago, I don't know that there's really a ton left to do in that space and whether that will scratch the itch. The other thing is, if PFOF is really causing conflicts, right, is there an existing rule set that works to solve that? And some would argue that best execution does exactly that, and can you go down the best execution path and maybe, and I think FINRA has done some of this, continue to provide more clarity around what expectations are, and is that another way to get at it? But it's simple to decide it's a problem. It's really, really complicated to figure out what to do about it.
Mm-hmm. Yeah, I don't know what it means to get rid of it. Like
right.
Does that mean maker-taker is then not acceptable anymore? Mm-hmm. And what does that replace the world with? And does that mean everybody's charging fees and drive things off exchanges? And does it reduce transparency? To me, like the CAP conversation and payment for order flow, and a lot of the regulatory things I was thinking about before this, it's all about transparency. And they seem to really want to have a deeper look into how are we doing business? Are we treating our customers as fairly as we say we do? And I think that 606A1, while a ton of work, I implemented that at our shop, there's a lot of transparency out there, and I do think that there is a bit of a gap in it that they're trying to address where, one broker-dealer may route to their affiliated broker-dealer, and because of the part of the rule where the affiliate says, oh, it's from a broker-dealer, I don't have to report that activity because they're going to report, and then there's just a report saying, I sent everything to my affiliate. It's just, so I think they're trying to address that like lack of transparency maybe they didn't think of when it was originally contemplated. But I really think that trying to have as much transparency around it helps with those perceived conflicts. And if you consider, like, I consider it's more like a profit sharing. There's profit sharing, and then those are going back to customers. Commissions went to zero because of all this payment for order flow. A lot of it, if you look at the numbers, it's probably a lot based on option order flow. That's where the bigger dollars of payment for order flow in these 606 reports are coming out of. So it seems like you're going to cut off your nose to spite your face because of what Steve said. Like, I kind of don't like it, but I don't know why. And if you can just provide the proper amount of transparency, maybe people can get more comfortable with that.
Right, and the simple message of, well, if you kill it, you probably kill zero commissions, tends to make everything seem a little bit more toxic to delve into, too.
No, and I think it's the central problem of what problem are we trying to solve? Because it is, you have the potential for conflict of interest with payment for order flow and some level of distaste, but I think it's also important to look at the market structure. Clearly, differences between equity and options. Disclosure regimes certainly help that. Best execution requirements help that. 606 reporting quality helps. I think that we all know that there's some gamesmanship in how those happen. But it is economic sharing, right? Because it's irrefutable that there's an information advantage to order flow, right? And so being able to share that with the firms that introduced it, it's Slade said it's a form of profit sharing, because the only thing worse than payment for order flow is no payment for order flow, because I really don't think we needed to organize a bake sale for one of Steve's former firms that really having a hard time making ends meet. And I also need to stress that the drink coupon in your packet from Citadel was not alcohol for order flow in any way, shape, or form that needs to be disclosed. But what you'll see is it'll manifest itself into other forms because there's economic value to who got the order first, right? And so whether it's this version of payment for order flow or some other economic sharing, there is a symbiotic relationship between an order provider and somebody willing to provide execution services. You need to make sure that those conflicts are understood and are transparent.
So do you think then we're ultimately trying to fix it the wrong way by, to your point, do we focus on what is perceived to be wrong with it and then address those issues?
I think you got to look and say, has execution quality improved or not over this period of time? Do we have a more diverse set of market participants before? Has it helped retail investors by getting commissions down? And so is it a greater good theory? Because it's almost the Hippocratic Oath. First, do no harm, right? So if we want to change something, let's make sure that the potential change, we know the unintended consequences, because I do think it is like throwing the stone in the lake. The ripples are going to spread out quite fast if you make a change.
Mm-hmm.
Yeah, I totally agree. It's all about this transparency it feels like that's the problem is people just, or the perceived problem, sorry, is that because you have that order and you're handling it, that you're, of course, going to advantage yourself over the customer. And having run a router for a number of years and competed with Citadel and gotten the execution quality reports from OV, they hold you to a very high standard for these things. I mean, they penalize you if you don't perform for them. So it generally is if I don't know. We'll see. Hopefully, the SEC or regulators can articulate where they think the conflicts are and how that could be more transparent.
Yeah, and I think that's I agree with both Slade and Scott, right? That the level of transparency out there right now is imperfect, but still fairly. The regulatorily mandated disclosures are imperfect, but still relatively robust. I think there's general agreement that 605 could be modernized in a way that would be really helpful. But in part, that's been filled in by firms demanding enhancements on 605. And so the level of competition and the level of transparency are both very, very vigorous, and I tend to think that solves many of the concerns one would have around doing things that are being done in a conflicted way. Yeah.
We'll ask a couple more questions before we open it up to the audience, kind of two different lenses on it. What do you think about from an innovation perspective? It feels like, and Slade, we were joking around about this before we came up here, like, when you think about what's happened over the last 2 years, or I think that something happened 2 years ago, it was actually 4, right? We've sort of survived the last 2 years, and it's been managing sort of a series of risks and changes and adjustments that we've all had to make in our lives in a very, kind of fast-paced way. Where do you feel like that's left us from an innovation standpoint, from an options industry perspective? Like, if you think about where the growth is coming from, what are some other changes that maybe should be on the horizon that we're not talking about? I feel like, as we shift forward and think, okay, we're hopefully coming out of the pandemic and we want to think about some more front-footed things versus just surviving, would appreciate some perspective from an innovation.
I'm going to give a boring innovation answer in that I was really surprised by Henry's chart yesterday of how relevant all the exchanges are in the market share. And I think the box guys wanted me to point out that Henry had them at 3% and they're actually 5%. So the world is sliced up way more evenly, and then you saw it by group than I was kind of anticipating, where in the consolidated and liquidity providing space, it's really kind of clustered with 5 people or 5 groups, where the exchanges. So I'm interested. I'll be really interested how MEMX's exchange performs, because since Exchange 7, I don't know, I've been like, oh God, another exchange. Are you kidding me? Why? But somehow they're performing a need in the marketplace. They're grabbing relevant market share and adapting their business models in ways that seem to help the industry grow. So I find that really interesting. I'm really going to observe, be a student of how they grow their market and what they do to because they have to do something innovative to get market share away from the very competitive, exchanges that are attracting order flow today. So venues seem to be an area where there actually is some innovation going on, where I feel like we all feel like, they're all the same.
Fair.
But I also think there's an opportunity to where you started from, of simplicity. We've grown very complicated markets. Look at the number of strikes. But at the same time, we've also had product innovation. So you had quarterlies, monthlies, and now weeklies, and we'll have expiration for each day of the week. But it meets a need of an investor, right? They wanted a shorter duration product. So I think those are the types of things of, do the product solve a problem for the market participant? But at the same time, we can't have an unlimited proliferation of products and strikes, because it gets very complicated for all of us to manage sort of that overhead infrastructure of, 1.5 million products. So we have to think through of, what do the market participants need? What are the implications on market structure? And can we afford, as an industry, the burden of sort of maintaining that inventory of products? So technology certainly has helped a lot in all our ability to deal with that complexity, but some of the complexity starts to press the bounds of whose best interest is this really in?
Yeah.
And I tend to think issues like that, that's a place where the regulators probably should just leave well enough alone, right? I would have said that the maximum number of useful options exchanges was 5 exchanges ago. But as Slade points out, right, there seems to be reasons why the market responds to it. And so I think historically there's been that complaint about there's too many venues, it's too complex, there's too much fragmentation. But again, I don't think you want the regulators deciding what that optimal number is. The market's going to be very effective at figuring out what that optimal number is.
Yeah, I think that, to Scott's point about the new expirations, and I hated weeklies. Like how off was I on that? That was a decade ago, but it's really about, can we as an industry have some discipline around going, and our listed option market structure working group is working with some of the exchanges on, like, okay, let's do some analysis on what the week 4 and 5 really don't trade that much, and they create a lot of traffic, and so that's risk for market makers to have out there, and can they concentrate that more on where products are that are actually trading, and can we delist some products that are eating up our scarce resources, bandwidth, all these different things to process this massive amount of data and focus it on where there's actual activity and customer interest. And you try things, and then don't just be stuck with, because it exists, we have to quote it in perpetuity. Let's have some discipline around adapting both our successes and our failures in the market.
Well, thanks for that. I guess finally, what are some of the things that worry you, keep you up at night? Planning your retirement?
You're only going to get an answer from Slade on this.
Now, actually, I think for all of us, it's the cyber threat, right? Information security and the protection. If you want to disrupt the U.S. financial system, taking out the center counterparties, taking out the exchanges, hitting the broker-dealers. No one's going to attack OCC to steal the money. We don't have the money. It's in another bank. But if you want to disrupt the financial system, we're all very attractive targets to do that. And as my chief information security officer keeps telling me, I'm the weakest link in the chain because it's going to be the one employee who clicks on the email. It's just making sure that we got the training and vigilance in place with teams behind it, because it's what we owe the market participants, is not to be vulnerable.
Mm-hmm.
To me, it's that this great customer experience somehow falls apart, that we don't continue to invest in our quote taker plants, that the liquidity somehow vaporizes in the market flash, like flash crash type events really scare me in that would provide bad experiences for people and opportunities for people to say, yeah, see, options, you never should have gotten involved in this, and headlines and things like that. It's really about continuing to invest in this business. And I think we've all done that and kept up with this amazing growth in the quote traffic, but it's keeping real vigilance around the customer experience and maintaining that perception that I'm getting a good deal. I know what I'm trading. I think I know what I'm trading. Maybe I don't understand that option on a VIX. Maybe they don't really understand what they're doing. But at least they know how much they can make, lose, and there's liquidity for them at all times. That's my biggest fear, is that there are liquidity gaps in the marketplace that provide bad customer experience that hurt us in the long term.
Mm-hmm. Those are both outstanding answers, I think. And Slade, I think on yours, I do worry that the customer experience over the last few years has been great, but I think it's quite possible that the increased number of folks who are in the market is of a different type than prior participants in the market, and the first even sort of moderately rocky experience is going to be something that's really going to shake them. And I think, in getting back to the importance of the roles of intermediaries, that being the brokers being that first line of communication and education is extraordinarily important, because I do think there is that possibility that you're going to lose a lot of the gains in terms of broader participation when you have those first couple of incidences.
Yeah, and I mean, we're seeing this breakdown in whatever the crypto products that broke their dollar peg and they're now trading 20 cents. We'll see how much bad press, or obviously you're going to get bad press, but how long the effect is on a complete breakdown of liquidity in a marketplace, and perceived risk that wasn't there that actually is there, that's massive, that people didn't understand. Like, if we can stay away from that sort of thing, I think is really the key.
Well,
here.
and I think that's also a really important point, right? Because I do think the structure and the protections in crypto are nothing compared to what they are in options and equities and futures. Mm-hmm. But if it's something other than the plainest of plain vanilla liquid equities, if a problem happens in crypto, which it just did and certainly will again and again, how do you make sure that it doesn't sort of wash over and have a contagion effect on asset classes like options?
Well, but it's easy and fun to point at crypto, but we had a major metal exchange in Europe who had some market structure challenges, who challenged people's understanding of what's going to happen in default management. So I think that's also part of it, is making sure we're transparent. You understand the rules of the market when you go in. What are the risks and reward when bad things happen? How's it going to be unwound? because those are the things that cost you investor confidence, and you lose investor confidence, there's no volume.
Yeah.
I'm sure you have plenty of things. Can we ask you the question, Alicia? To throw it back at you, because I'm sure you have plenty of stuff to
Yeah, I mean, look, I would say all of those are spot on. The other one, I would say that we spend a lot of time thinking about, in that role of first line of defense, what does that mean to us? And when I think about where the ecosystem may go, who the new entrants are, it is a very different playing field from a regulatory standpoint, from a competitive standpoint, from an economic standpoint. And we can do things or can't do things in a different way than some other firms we're now competing against. So what does that mean? And that starts to be where I actually have real concerns, right? So agree 100% with all of that. But from like a risk management, market integrity, customer experience, all of those things, when it's not a level playing field and the risks aren't understood, we end up kind of wearing the burden of that. The other one, and I think the LME example is a good one. When you think through what happened, we've spent a long time debating obvious error rules and bust adjust and protections we want built into exchange and matching engines, so you don't end up in the kind of moral hazard of having to bust 8 hours worth of trades 12 hours after they started. How did we put that responsibility earlier in the chain where we understand what can go wrong and we're being sort of responsible citizens to deal with that up front? Because the second you have to undo actions, the worse off we all are. So I would say, it's a couple of different things. The regulatory burdens of being in some of these businesses can be really challenging. They're appropriate, and we understand why. They are for the good of the kind of broader industry. But when there are folks in the ecosystem that don't have the same regulatory standing or requirements that we do, I think that creates a level of complexity and challenges that will impact retail investors over time. So that worries me a lot.
I think we ran out of time.
We did. I was going to do the lightning round on your retirement plans.
That's the least interesting topic.
But there we go. Well, thanks very much. I appreciate your time and your perspective. This has been terrific.
Thanks.
Thank you.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.